In this video, we are going to demonstrate the use of common size balance sheets to make comparisons for a particular company over time and to facilitate comparisons between two companies. This is the balance sheet for Amazon and for Walmart for calendar years 2012 through 2016. Now, the balance sheet is on one particular day, so these would have been on the last day of the reporting period for these companies. Walmart reports in January of 2017, as do many retailers. They report January 31st, 2017, but the numbers in the statement cover mostly calendar year 2016. So that's a common approach with retailers. So these are for comparable time periods. Now, it's hard to make real comparisons because it's hard to judge when you're looking at big numbers. I know these numbers are for Walmart are bigger. All right, that's two, and they're in millions of dollars. So Walmart has, for example, in calendar year 2016, almost $200 billion of assets compared to $83 billion for Amazon. And Amazon has close to $26 billion in cash. Walmart only $7 billion. But then you look at they got $43 billion in inventory, and it's been $43 to $45 billion for a long time. Notice that Amazon's has been getting bigger. Walmart's total assets have been stable, but Amazon's are actually increasing. But it's really hard to make a comparison with all this because you're comparing the numbers for an $80 billion company over time. It started at a $32 billion, and now it's close to tripled in size. We can't really see what's going on with this firm just looking at the raw numbers. So anyway, a common size balance sheet, all you do is divide all of the numbers in the balance sheet by total assets. And then we can start talking about, well, cash as a percentage of assets as opposed to as a dollar amount. So I'm going to do that for all the asset side as well as the liabilities and the equity side for these two companies. All right, now I already did the calculations, and they're in this second spreadsheet, which you have access to, that's on the out in Blackboard. All right, so some of the stuff we can see with Amazon, cash is a fairly large percentage of total assets and has been fairly stable across the period, right around 31%. We also see net receivables, the accounts receivable, fairly stable, right around 10 or 11%. Their inventory has declined. Inventory as a proportion of assets has actually gotten a little smaller, and total current assets have declined somewhat. Notice that the land as a percentage of assets has doubled, almost doubled over this period of time, and fixture and equipment has increased. Amazon has been on a building spree, building warehouses and data and fulfillment centers. Now, they don't buy all of their equipment, they lease a lot of it, and that doesn't show up so well in these statements because certain things, like if you lease equipment rather than buy it, it often doesn't show up on the balance sheet at all. But what we can see is Amazon's assets, their hard assets, have been increasing over this period. Walmart, by contrast, if you look at their property, plant, and equipment net, that's just steady as a rock. They have increased the gross assets, but through the depreciation, they pretty much replace just about what they buy. So as a percent of assets, there's been no change. In fact, you're looking at Walmart, everything is pretty stable from year to year. All right, one on a percent basis, every year looks identical. While on the other hand, on Amazon, you're seeing some changes. So flipping down here to the liabilities and equity side, then let's see if we see anything else that leaps out at us. All right, there is no short-term debt. Notice the accounts payable. Accounts payable is money Amazon owes to its supplier. As a percent of assets, it's gone down from the 2012-2013 level, and now it's running about 30%. So they dropped a considerable distance from accounts payable. The total current liabilities, that's probably the major contribution towards reducing that from roughly 58 to 52%. Total liabilities was about 75. It's slightly higher in the last few years. Notice that capital leases have increased substantially. A capital lease is a long-term lease that appears on the balance sheet both as an asset and as a liability, because you owe when you lease say a store, you owe the rent and you've agreed to pay it over a number of years. Then that's a liability and should appear on the balance sheet, but it's also an asset in that you have a place to stay. You have use of that facility for a long period of time, but it's not the same as buying your own stuff, all right, your own buildings. Notice at Walmart, very little of the capital leasing. So what we do see is that between the leases and the long-term debt, that's generally a lot of the liabilities. Most of the liabilities for Amazon are short-term as opposed to long-term, and the bulk of them, accounts payable and accrued liabilities, is money you owe your employees but you haven't paid them yet. Okay, so if we come down here and look at the total equity, Walmart roughly high 30s, call it 40%, which is about 15 to 18 percentage points higher than we see over here with Amazon. So Amazon uses more financial leverage. They have higher proportion of liabilities, about around 75% compared to about 60% for Walmart. So we do see a few things in here that are different between the two firms, and we also see some trends here, some things that are changing over time for our friends at Amazon.